Live streaming is on.
All right, good afternoon, everybody. Friday afternoon here in the markets, and we are about to kick off the October episode of the Sentiment and Flow Show, and we do it with the markets under pressure. We're going to be keeping an eye out on this as we're trading right around 42.62, just hovering above the 200-day moving average on the S&P continuous. So obviously a key item that people are going to be looking at. We got a lot to go with about an hour and a half left until we close up the markets. So certainly expecting some sort of headline about an Israeli offensive or something along those lines to come, as I would expect shorts to try to flush us down lower. So it's something we are going to be discussing with, of course, none other than Brett Manning, chart trader. Brett, always a pleasure to have you on here as we start talking a little bit about the markets and go through
It's good to be
some of
here,
the
buddy.
sentiments and positioning flow out there. Yeah, definitely good to have you, man. So I guess let's just kind of take a look at today's price action. We'll break into that first. Get your thoughts on what's currently going on here and whether or not you have any sort of trade that you would kind of be leaning towards going into the close.
I really don't. I mean, the direction is down. I'm not going to buy this tape. But for reasons that we're going to cover, I have an awfully difficult time shorting it right now. I think there's a better opportunity around the corner. And it's just, and again, you know me, when we get into the first 2 weeks of earnings season, I tend to get a little bit quiet because we have a lot of different kind of flows. The other thing I hate is exogenous headline minefields. You know, who's going to be Speaker of the House, war breaking out in the Middle East. When there's factors like that that have nothing to do with the internal dynamics of the market, but there's still, they have a significant impact on how the market is trading. That's also something where I can't use my edge, and my edge is reading the price action and understanding the positioning. And those factors are outside of it. And when you get the first 2 weeks of earnings season, you get a different kind of flow. You get a lot of bottom-up positioning adjustments from significant players with deep pockets who don't very often interact with the market. They're once a quarter people. And when you get those folks controlling the action, positioning for earnings reports, there's about a 2-week period there when we see that SPY liquidity premium really drop through the floor, where I find I'm less successful over, I've been doing this long enough to know that that's a pocket where I'm less successful, generally speaking. As soon as we get into the mega caps or most of the way through the mega caps, my accuracy tends to pop back up. So we got both of those things happening at the same time right now. So I'm really kind of, trying to be very selective. If I see the perfect setup, I'm going to take the perfect setup, but it really needs to be the perfect setup to me today.
Yeah, and that's certainly a critical notion, just being able to know when you have an advantage and when you don't, and to
Huge.
be able to pull back
Which is
when
another
you don't.
advantage of experience, right? I mean, like, you get a big enough data set on your own self, your sample size increases, you can pick out trends easier.
Yeah, no, exactly. So, and good explanation of why, with in terms of the large money pockets and the positioning that goes in around this first, second week of
It's a
the
different
earnings
animal.
season.
Yeah.
So, obviously, I just posted the week ahead. We'll talk with Brett about that at the end of the session as we look forward. But one thing that Brett, I know you're a pretty big component of, and that's how we close. So what are some of the things that could happen over this last hour and a half of trade that would garner your attention? Not saying that you think it's going to happen, but if it did, that could impact your mindset for next week.
So in this case, I'm not a big proponent of how we close, because in this case, I don't know if there's a read through to the type of dynamics that I'm most interested in. I think, it would be difficult to disentangle the idea of people really being afraid of some major escalation in the Middle East over the weekend. And that's not necessarily then the read through that I'd be normally associating with a particularly stronger week close, which tells you something about institutional positioning. In this case, it may be a great, institutions may be starting to move in, but still, it's, do you really want to buy right in front of this weekend? I don't know. But their mentality may still be they come in Monday and start buying if there's not a big escalation. We don't know. So it's not as much of a signal, I think, now. because of this weekend, news headline flow gap.
Yeah, no, that makes sense. All right, let's break into the sentiment and flow show then, Brett. We've got the presentation here, and we're just going to be chatting a little bit about some of the different items that we're seeing out there. So, taking a first look, Brett, as per usual, the AAII data, we like to focus on this as a helpful read for the broader market, certainly get an idea of where people are situated in it. So, taking a look at this number here, give me one quick second as I just trying to change a few things around. We've got it was a weird week or weird couple of weeks really, where
Yeah.
last week the neutral number dropped all the way down to 23.5%. Everybody was in one camp or the other. We saw a
Yeah.
big jump in bullish sentiment from October
That's rare.
4th through the 11th, and then a drop off in bearish sentiment and a drop off in neutral sentiment. So when I was going back, I was looking at some of the past performances similar to that. April was an area where we saw close to 23% in the neutral rating. And then the year before, around in 2022, at the beginning of the year, neutral sentiment was that low. Now, that also was because bearish sentiment happened to be up around the 50% range and stuff. So then we come into this week and saw the drop in bullish sentiment. I was not surprised to see that. I was surprised to see the drop in bearish sentiment, though. And then, like everybody, it seemed to be moving into that neutral camp as that jumped back to 31%, where it was back on September 27th. So I'm curious to hear your thoughts on this action in the AAII data the last couple of weeks, because it hasn't mirrored what we've seen in the past.
So what I'll say is in this kind of flow for that data set, I tend to pretty much disregard it. When you go 4 weeks with every week being a completely different kind of picture, that's why I like this idea of when it does something consistently over the course of a number of weeks, then you get a read through into how people are positioned. And ultimately, that's the point of sentiment data. If you can't get a read through into how people are positioned, it's really not worth very much, because people's opinions can change week to week, but their positioning doesn't that much. So it's when it festers in one zone or the other of some kind of extreme. The last week is kind of interesting because I've never really studied the idea of a polarized market where the neutrals are really low and the other two are high. And I'm curious, maybe I'll go back through some data and just take a look at that this weekend, but because it
Well,
may be kind of interesting.
I posted on that because I was kind of curious too, and actually the market's performed
But
well
I'll tell you what, again,
following those episodes.
but if it did it for 5 weeks in a row, I'd be interested. You know what I mean? If
Right.
you take somebody's opinion one week and then it changes the next week this drastically, I don't find that there's a lot of edge. So I don't think there's a lot of edge in this indicator right now, one way or the other. And so I just kind of, if it starts to do something interesting, I'll look at it. When it's in the zone of things I've seen that don't really attach to reality in a powerful way that I feel like gives me an edge, then I think it's best just sort of ignoring it.
Okay, so you're not finding much help going on in this data at this
Not
juncture
right
then.
now. Yeah. I mean, if it starts to settle in the 26 area for 3 weeks or 4 weeks, then on the bullish side, or the other way around, then I'll start to take interest in it, because it's showing you something about how people are positioned.
Does it have you concerned that bearish sentiment hasn't popped back over that 40% yet? We're seeing this sort of price action.
Not really. I mean, it could be it doesn't call a return. Like, you could do a chart of these sorts of indicators. In fact, we'll talk about the put call and hedge fund exposure later, just as kind of an interesting overlapping thing. Like, you can overlap lots of different things. They don't all have to be together at a significant turn. As long as they're not completely contradicting each other, you can still get a signal. So if this one's just not really signaling the same thing that a lot of other things are, that's okay. That doesn't mean that the view those other things are signaling is wrong. And the sample size on this is like 500 people.
Right.
There could be all sorts of variations in the quality of the signal.
All right. So one of the things that I would say has been in a trend now, and that's the bullish 8-week moving average, which has declined steadily from September 7th through the 12th, and would have been down again in the 19th on that 8-week moving average. So that would be one area where we're seeing a trend. So does that stick out to you?
Yeah, I mean, it looks just like the market.
Right.
I mean, pretty much
Uh,
like you can kind of
Certainly
overlay
echoing the
that.
market.
Yeah.
So but nothing really jumping out the page. You're talking about how you
It's
like
not
trend,
extreme
but that
enough for me to
trend's not.
take it as a signal. Yeah.
Okay. And that's probably because that bull bear spread's just a little bit more fluctuating.
When just week to week, it's just changing. It's just sort of like it's not one of the things. It's not one of the people in the room that I'm going to call on to give me an opinion.
Yeah.
It's one of the people sitting at the table that I'm going to say you could just be quiet, and I'll call on
Yeah.
somebody else.
All right, then we'll move on from that data point. Market characteristics, Brett. Just some of the 30,000 foot level items. Obviously, choppy conditions. Certainly with the downward bias. We've been range bound though at the end of the day since June, from between 42.50 to 46.30. So we're right around those June lows there. I know that's a 10% swing there, but at the end of the day, when you kind of scroll back, is
Hey,
negative.
Gavin, can I
Yeah,
interrupt you real quick? I
sure.
just clicked on Trader Audio, and it's still showing Jim's chart,
Is it okay? Let me.
and I saw feedback to that effect. So we definitely want people seeing these slides.
Okay. One quick second here. Okay, I'm seeing my slides up now. Are you seeing it? You seeing that too?
Let me check. Yes, we're good. All
Okay.
right, go for it.
All right, should be good. All right, so market characteristics that are in play right here. Again, those choppy conditions. We're just talking about that. Talking about the range bound. We are obviously near the low end of that range in a downward trend, so that bears watching for a potential flush. Rates remain a headwind as the 10-year approaches 5%. We saw it get above there for a brief moment in time. Yesterday and early today. It has since receded back to that 4.9 area, but obviously remains in striking distance. Geopolitical tensions have flared up. The Israel-Hamas war, as Brett was just talking about, with that weekend concerns. And you, of course, also have the debacle going on in the House with the GOP there, unable to elect a leader of the House. You got, which, with the government shutdown coming up, that's certainly not helping matters, especially on the rate front. ICI report, Brett, that said that the second straight week of money market fund outflows. I was a little surprised to see that given rates. S&P trading at a little bit more palatable 17.7 times now with this pullback that's going off a PE of 240. Early indications from earnings reports really haven't suggested a big change in that. I know that there's been a lot of anecdotal evidence, with the beige book being the latest, pointing to the idea of margins being crimped moving forward. And that leads us to the next bullet point. That's margin concern. And then credit. Obviously, everyone's keeping a close eye on that, but this remains pretty benign from what we've been seeing from the banks. And we have gotten the majority of banks out at this juncture. So, Brett, we're going to be going deeper into each one of these, but is there anything in particular that's jumping out off the page to you on these market characteristics?
I mean, nothing really. I could never trust the credit idea, just because
In terms of,
credit was benign in mid 2008. Like when you listen to the banks, when you listen to
sure.
Lehman talk about what's going on. So who knows where that's really at? And then when you get hard data, it's always lagging. Obviously, I take as my number one input as being a really the chart of bank stocks. I think. I think that's the information processing idea of the market. There's people,
So
especially
so
that
you're
industry. There's people there who know what's going on inside of their banks. So it worries me a little bit to see what we saw in the regional banking index this morning.
right,
Um,
just the
eh,
meltdown despite decent results
yeah,
and everything.
I mean, to me that's not like shorts trying to take him down. That's there's information that we don't have that's going to be surfacing to me. Um, and we're nearing a so that's there's a few technical signals right now that are frankly awful.
Yeah.
And so we're going to get into this as we go through the sentiment and flow show. We're going to get into this kind of argument between these two sides of things. And one is like, there's really good data showing that we have to be very near an important low. And there's really good sort of, technical flow kind of observations you can make that really look terrible. And the two, are kind of in flux. And ultimately, our job here today is kind of present both and kind of weigh in.
All right. Let's weigh in on what happened with Powell then yesterday. Obviously, a lot of people talking about that. I have seen interviews of people talking about how hawkish Powell was. I have seen interviews of people talking about how dovish Powell was. So, my primary take. I mean, here's some of
He's an
the
ink blot.
items.
He's an ink blot test.
Yeah, yeah. What a Rorschach test, right?
Rorschach, yeah. There
So
you go.
the basic tenets: economy remained strong, job markets remained tight, but did see some gradual decline in wage growth that he said would be persistent with getting back to 2% inflation. Household savings and spending remained strong. We've certainly seen that. American Express this morning being being the latest. Let's see, and just make sure Scott doesn't have trees. Just talking about the regionals there. Um, didn't He didn't want to predict a terminal rate. I did defend the banking system.
Never predicts the
Uh,
terminal
b-
rate.
right. That was on solid footing. Perhaps a hint at changing capital rules, and we'll talk about that a little bit. Evidence the Fed is too tight was a comment that he or was not tight enough. Was a comment that he made that really sent the markets spiraling
Yep.
lower, as well as a comment about and perhaps entering a phase of higher
Yeah. We
inflation.
get that sort of 3% is the new 2%.
Right. And then he obviously talked about QT fiscal policies, term premium impacts on rates. So there is a lot to unpack from his conversation. And again, if you were to listen to the whole thing, which we did, there was easily something he could take from both sides of the aisle. The end piece for me was that it was so all over the place that it just really brings us back to square one, which is
Sure.
actually what the spy did, Brett. If you're watching that, from where he started speaking after a few roller coaster dips and rises, we were right back to where we started
Sure.
this before his session. So, and that is that we still remain kind of on the footing of data dependency and everything, but that there still was some important items that he brought up, and I'll just kind of fire them off to you. Number one, the economy remaining strong. Um, Economic data kind of forces that. Do you see anything that is raising a red flag for you on the economy? Do you think we're kind of getting like peak economic data that you're expecting to see fall off? And how do you think the market's going to react to a bad is good number moving forward?
So I kind of think at this point, just taking it from 30,000 feet, listening to Fed speakers lately, I think the market is probably at the point where they're not going to take the words that come out of Powell's mouth as necessarily that important right now, because I think we know he's at this gray area zone where maybe that's it and maybe it's not, and they're data dependent. And so people are going to place their bets on what they think the Fed is going to be the next data point the Fed's going to have to deal with. So there's going to be economic projections from individual market participants will become more important. I think some people are going to have this idea that the household savings situation that was fueling everything is run out. And, Q3 was kind of a blow off GDP number. And we're going to start to see a very different economy take shape. We're going to get a recession in Q2 next year. So we've got this narrative painted out in their minds, and they're looking for data that confirms or denies that. Other people are looking for this is about the point where we see this reacceleration in inflation. And it's really going to be more tied to the fact that, we looked at that JOLTS number. Like suddenly we've got this job openings problem again. It's tightening back up. We had the jobless claims back under 200,000. Like, the Fed doesn't seem to know this. People are saying the Fed doesn't seem to know this is about to happen, but here's the next thing they're going to have to deal with. I think that that's going to be the driver of the market, is people just starting to, they see the Fed in this middle point and at a fork in the road. And it's about placing your bets on which direction the Fed's going to have to turn, rather than listening to every word that Powell says now. That's my
Yeah,
sense.
no, I agree with you. And I think one of the bigger problems too, Brett, is I really don't think that the Fed's in much control of what's going on in the rates. I think a lot of it
No,
has to
not
do
at all.
with number one, the potential buyers drying up. Obviously, the Fed with their quantitative tightening, and they're unloading the balance sheet. That's not only is that a big buyer of rates out of the market, but a seller too, a major seller. The other is Japan being out, right? Because they got to defend the yen, and in order to do that, they got to sell their dollars. They're the biggest international holder of treasury bills. China used to be, but we know what's going on there with that relationship. So you don't
Right.
have Japan in there. And then the other thing, and this I thought was kind of interesting, it goes to the banks, right? Where they are expected to have some additional capital requirements that are going to be put in place. We've certainly seen Jamie Dimon talk about how onerous it's going to be and everything. And that was one of the things that I thought was really interesting in that Powell speech that just doesn't seem to be getting any coverage.
Which
And
is,
that was Powell noted that he is very interested in hearing the public response. That Fed's given 30 days to hear what the public has to say about bank capital requirement rules, which would be Jamie Dimon and all that crew. And he didn't really. He said that they were very open to hearing what they had to say. And for me, I felt that it was something that it was tantamount along the lines of perhaps we might ease some of those capital requirement restrictions that we're talking about. And that would open up a decent buyer from the primary dealers for some of these bonds that could help alleviate some of the pressure on the upward momentum that we're seeing. I don't know if you got a thought on that, but
I mean, my thought is, my sense is that, treasuries are a tier one
capital.
yeah, I mean, right. I mean, that's the highest quality that you can have.
Yeah, but if
loan
they've got
against.
capital requirements against it, and you got these these paper losses, you're looking at like Bank of America. They just had $131 billion paper loss to their treasuries from where it's marked to and what the current value is. They said that they're going to hold it to maturity, so they
Yeah,
don't view
it's the
they view
stupidest
this as
banking
nothing more
crisis
than paper
ever. I've
loss.
said this before.
No, I get that, but it
It's
still
just ridiculous.
impedes their ability to purchase treasuries. And if they raise these capital requirements, and one of them, of course, is how they treat the AOCI write downs, which is where these paper losses would be, where all of a sudden you could have a bank like a Bank of America reporting a loss of 22 cents per share or whatever it would be, because they have to all of a sudden bank that $131 billion loss.
Okay, I
So
guess what I'm saying is, I
these
would
are
think,
all being included in the
yeah,
capital requirement level.
I guess what I'm saying is that they hold a lot of assets, and there's probably a food chain there, and there's the stuff that they're going to eliminate demand for first is probably not going to be U.S. treasuries.
Well, it will be if they have to take AOCI losses. That's the thing, Brett. I mean, so it is notable what he's saying there in terms of who could buy these T-bills. So I mean, I don't think it's nothing.
Okay.
That's for sure.
Well,
So
you are the expert when it comes to the plumbing of the financials in terms of how they report. So I will take your
yeah.
word for it.
So it's a notable change. It could help alleviate some of the pressures, especially, and we're going to talk about this in just a couple minutes here. If you're looking at what is actually pressuring those rates going right now,
But let me just skip back for a second. So basically, what you're really saying is that statement that he made is something akin to the Fed trying to throw out a lifeline to the bond market.
correct?
Okay, yeah, that's important. Everybody listen to that
Yes. And for these banks too, for that matter, which
because
is
the
we
market
were just
overlooked it.
talking about, are getting crushed. I
Yeah.
know, I know. That's why I
So,
mean, maybe I'm reading too much into it, but I just thought some of the statements that he made around that
well, check your math
were
and get back to
pretty
us because that
important.
could be a hugely important insight.
Exactly. So we'll keep an eye out on that. So let's
Okay.
break through and we'll delve into a lot of these things here. First, here's the bond yield outlook. This is from the Bank of America Fund Managers Survey, and 56% of fund managers see lower bond yields in the next 12 months. You could see that's just kind of been spiking up here. This is the highest share of respondents on record going all the way back to 2003.
That's
So
troubling.
obviously,
Yeah.
they think that something's broken here and they think that it's going to be fixed. So, what's your thought on that response?
Well, I mean, it's just not what I want to see. Like as somebody
Yeah,
who, wants to see sort of order maintained in markets, I don't want to see, you know, this like chart showing me that everybody's assuming that the upward trend in yields is over and they're betting on the opposite direction because that's usually not what happens at the turning point. Generally speaking, in market trends, it's basically the comment that it's a great time to buy bonds. Just
right.
right and to buy the ZN or the ZB. Like, is that the sentiment indicator you want right now? Is that everybody's recommending a long in ZN futures?
As they're getting crushed and going down.
Well, I mean, I want to see the capitulation. I want to see everybody just go, the yields are going to 10%. That's it. Everything is completely screwed. I want to see that,
Right.
and then I feel a lot better about things because I don't want this grinding move higher where everybody keeps on getting recycled out of their poor positioning.
Yeah, and that's exactly what we're seeing there. We've seen
Bonds are a
this
little
through.
different though because you can hold it to maturity. You can mark it different ways, but still, it's not ideal as a signal. So we'll
Right.
file that with the one side of this debate.
And in fact, and it factors into the idea that the Fed could be cutting rates too, I'm sure, right? So,
Yeah, well,
um,
obviously, it's a bet on the
at
yeah,
least that camp anyway.
we're not gonna
Um,
see 6% GDP in Q4.
so again, what's driving yields? This is what we were just talking about, Brett.
Yeah. Supply and
So
demand is first.
this is from the Bank of America Fund Manager Survey again. 50% think higher government debt and deficits are driving it higher, and 32% think strong nominal economic growth. The idea that the Fed needs to raise to squash inflation. So as you can see, most people are just looking at this as more of a structural issue and a trust issue, I would say, and looking to be rewarded for a term premium, right? Where they're holding paper longer and they're worried when they look at the inability for the government to elect a House Speaker, to
Yeah,
create a
there's a
deal.
faith issue, yes. There's
Right. And I mean, this is all part of the reason why Moody's or
Moody's
who downgraded us in August?
Fitch, right?
Fitch. Yeah. I mean, this was the very reasoning, and we're seeing it play out right
Well,
now.
can you imagine
I
the
mean,
you know, the
it was like, "Oh, they're ridiculous. Our government works fine," and it's not, right? So
well, I mean, can you
there
imagine the sort of marketing campaign for selling any interest in this country that's gonna happen next year with the presidential election we're facing? Like,
yeah,
it's gonna
but,
be, yeah,
I
they're
mean, think of
really,
the
really tough
vitriol
for
that's
people to
gonna
have
be
faith.
going on from both sides and
Yeah, it's
everything.
gonna be really tough to keep
It's
faith in the idea that this is a functioning
yeah,
situation.
and that falls into the 50%. Now, I don't even see what I think is the biggest issue
Yeah, you're
here,
talking
and
about
that's the
demand, right?
buyers. Yeah, I'm
Yeah.
talking about the operational day to day. I mean, certainly the high government debt and deficits are something that people look at, and Powell addressed this on his during the Q&A saying that it is sustainable right now. However, the ultimate trajectory of it is not sustainable, and I don't think that's surprising really to anybody. But I mean, again, to me, I think one of the biggest issues is just the buyers that have dried up. That we haven't operated in a bond market, Brett, without the Fed kind of sticking its nose in
It's
it
been a while.
for really the last 15 years, right?
And a
I mean,
generation of fund managers.
yes, and I don't think. I mean, certainly people are. Well, I guess you could look at point A, the high government debt and deficits being an issue, because instead of the Fed just being like, yeah, we'll take the paper, that's fine, and everything, it is people that are saying, well, we'll take the paper, but they're demanding that higher yield in order to take it. So you don't have somebody as complicit as, say, the Fed in buying that paper. So I guess from that aspect, it does factor in here. But again, Japan being out there, the banks being out there, the primary dealers. So I think I guess you could argue that the one side is, but I think my biggest takeaway from this chart here, Brett, is that the Fed really doesn't control this. And you were mentioning this earlier. I don't think if all of a sudden we see a dovish Fed outside of saying that they're going to stop the balance sheet unwind and start building it back up, I don't see anything that they could really do that's going to cut these rates just yet.
No, we're going to need to see a negative jobs number or something.
Right.
That's going to do it. That's going to be what does this.
A negative jobs number. Just
something just hey, it's not, like there's that side of it. Interest rates at the long end cannot. The United States is not a banana republic. It's not going to be treated like one. There's a loss of faith a bit marginally, but it's not going to suddenly be Zimbabwe. And if we throw out a negative jobs number, the rest of the world is going to be in trouble too, and money's going to come into the place where they know they can get it back. And a lot of that's liquidity. It's just the most liquid bond market. It's the most liquid currency market. It's the place where you can put $1 billion in 1 minute and get $1 billion back out the next minute without slippage. It's the only place that you can do that. And so there's just an inherent advantage there. And that's what we get. That's what we built for decades. So that's still what's going to crack this. I think is just people or speculation on that, or the market discounting that. I mean, but if we're headed for, back up to 6% inflation and 7% GDP, we got a problem here.
Yeah. And that Q3 GDP print next week should be pretty hot too. So
it'll be 5, right? I mean,
yeah, I believe
real,
so. I think,
real.
I mean, the bigger number is going to be that PCE number on Friday, though.
Right.
So, but we're still going to have to weather a number of big mega cap earners and that GDP number before we can get to PCE. So just taking a look, one of the other interesting aspects from Powell's Q&A was that he did address the idea that wage growth was starting to recede and come closer to a trend that would put inflation back on the path for 2%.
Gavin, can I interrupt you for 1 second? Somebody just asked you something. You mentioned $131 billion paper loss from one of the banks. Somebody's asking
Bank of America.
Bank of America. There you go.
Yes.
There you go, Pat.
Yeah. So that is in their balance sheet. It was up from 106 billion the prior. Again, this is paper losses. This is the hold to maturity bond pages that they that they follow through.
Right.
So
it's the stupidest banking crisis ever data point.
Right, exactly. So again, and Moynihan addressed this on the call, said that they were planning on holding to maturity, to Brett's point. So then it's going to be all part of what kind of losses they take.
Yeah, right. You got it. It's tier one collateral.
On the bond
it's fungible
valuation.
across everything.
Exactly. Yep. So services, food, energy, and shelter. So again,
Supercore.
So as I was saying, the super core. So anyway, this falls into what I was talking about just before with Powell pivoting a little bit from this inflation data point, Brett, to the wage inflation data point. And we've seen, I know, who is it? Krugman had that article out talking about how the Fed has won this, and he obviously got ridiculed for that because obviously if you don't need food, energy, or shelter, you're just fine on the inflation front, apparently. So,
I mean,
but I mean, it is
air and
things that
water aren't going up either, so it's okay.
well, water might be,
Water,
but
yeah, water too.
looking at my water bills, but to the point, the Fed is really limited on what kind of impact it can have at this juncture. Is my kind of takeaway from this. But you do see this back at that uh, July 2021 area there, just before the fiscal policy and all the stimulus from COVID came in. So that's cooled a little bit. I mean, obviously, shelter's still a significant portion of the inflation data and hasn't really cooled off. But looking at some of those housing numbers and mortgage rates, you might expect to see that.
Right. I mean, I always look at this sort of thing, though. I kind of sympathize with the Fed on and even Krugman a little bit. Just the idea is, so do you have a problem with the value of money? Because that's one question. Another question is, are the prices of certain things rising? And if the price of certain things are rising, that may not mean you have a problem with the stable value of money. And the super core, I think, does a good job of being a real canary there. Like if those are the things that are all going up, your haircut, your
Things that you could
cab
pull back
ride,
on.
like well, it's just that shows you it's the currency declining in value. It's so distributed on things that don't have exogenous forces driving them. It's the everyday things that everybody does. Everybody isn't always buying a house. Energy markets are controlled by the geopolitical situation. Food, there's all sorts of crops data. But if you get down to like a haircut and a cab ride are both moving up in sync, it's the value of money that's going down. You know what I mean?
Right.
And so
Yeah.
like that's the read through to being like, okay, what's going on here isn't that the prices of things are going up. What's going on here is that the currency is losing its stability of value. And I think that's a correct process, a thought process. But you're right. The headline inflation and the sentiment around it and inflation expectations will deal with these things too. Food, shelter, energy. Like people will feel it. They will start to expect more inflation, and that could bleed through to the value, the price you pay for a haircut, because people see this and they start to expect the prices of everything to be going up. And then when they start to expect that way, they start to behave that way. And the whole engine of, the real problem, gets churning along. And the question is, do we flip from a situation where that really hasn't happened yet in the last couple of years? It really hasn't. Inflation expectations have really stayed. But, this is about the time when, we were a few years into this and people keep seeing prices of things going up. That's why I'm worried about the crude oil rally. Like the Fed doesn't care about that, but they do care about inflation expectations. And so if the price of crude, with Russia and Saudi Arabia basically just trying to push up the price of crude at this point, pretty clearly, probably for geopolitical reasons, if that ends up causing an unhinging of inflation expectations, it forces the Fed into this, the worst place that they can be, which is this stagflationary paradigm.
All right. Moving on, Fed balance sheet, Brett, that's slowly coming down. We were just talking about that. So we see that edging lower. They continue to talk about unwinding this balance sheet. So they haven't really given a number yet. Usually they start hinting, in that $5 to $6 trillion range, whatever it might be. So as of now, they're full steam ahead in the unwind. Then, of course, the question that a lot of people are asking is the Fed done? I know Mester was just out saying that she's factoring in one more rate hike potentially. It certainly was in the summary of economic projections, but we're not seeing it in the CME Fed funds futures. That's
pretty
for
split
sure.
among Fed speakers, from what I hear.
Well, I mean, if we're just going from the dot plot, it's not, right? I mean,
No, but the recent, like
majority are
Harker was out this morning and said there
recent
will not be
commentary.
another hike.
Right. Recent commentary has cooled off from that. I'll be curious to see.
And I
Obviously,
would say that's
November
after
1,
the super core.
we're not going to get an update on that. That won't be until December. But
Right.
yeah, so
The
I
super
think
core
it's
was
fair
after
from the
dot plot.
commentary that we've seen that people are of the mindset that but I mean, a lot of it is they're of the mindset of pausing right now, Brett, but with the idea that inflation remains high and if that data continues, then they might have to move. That's, I would say,
Of course. And well, it also
where the vast majority lie outside of either they think they're done or one more left.
We also talked about this last time. I really see the dot plot now as not a genuine indication of what people expect. It is a communications channel device for maintaining inflation expectations. They signal their future policy expectations, and it keeps people from expecting more inflation. I really believe that. I think that they're these devices the Fed develops over time, they go from being an authentic expression of something to being a strategic asset. And I think the dot plot has evolved to being a strategic asset, and it's probably, there's a plan, and people are putting out a certain set of views, and they don't want those views right now to be, we're definitely done or we're cutting soon, because that will foment inflation expectations. So they don't need to hike again as long as they say they're going to hike again.
Okay.
That's how I read it.
All right. So, and then we got the first Fed rate cut as well. People still looking at that second half of 2024. And again, this kind of goes to that peak rate chart that we were talking about earlier. This will be data dependent to the extreme, I think, in terms of when the Fed's going to want to cut. But I would say that they certainly aren't of the mindset that they want to cut right now. And if they do, it's probably not going to be for a particularly good reason, right?
Probably not.
All right. Moving on to the Bank of America Fund Manager Survey. Some of the items that we've seen, it turned bearish again after.
So let me interject and just say this is where we're beginning to cover, the real sentiment side of the sentiment and flow show here.
Right. Because AAII told us nothing, right?
Yeah.
So cash levels jumped to 5.3% from 4.9. That's technically a buy signal for this survey. And this is just the overall look, and we're going to be getting into these 50,000 or 50% expect weaker global growth. Positioning says 4,200 on the SPX is the hard Q4 floor absent yields over 5%, which obviously we are potentially dealing with that right now. Global profit expectations are improving. It's the least pessimistic outlook since February 2022. That would factor into some of the valuations that we're expecting here. ISM manufacturing, the new orders and inventory signals rise back above 50. Certainly of note, because we're going to be getting PMIs next week, the preliminary PMIs Tuesday night and Wednesday morning. And then net 24% of people say monetary policy is too restrictive, while fiscal policy is too high. This is the highest since November 2008. So we'll get deeper into each one of those. But, again, kind of just focusing on the sentiment part of things here, Brett. I came across this Goldman chart that I thought was interesting. And basically what they did was they took a look at a few different areas: U.S. put call ratio, the AAII survey, CFTC, overall surveys and systemic issues, and aggregation of position and sentiment indicators. So what they define as extreme levels occurs approximately 12% of the time to the highest levels, obviously. There are only two instruments, Brett, that are falling into that right now. One was the AAII, which I know we were just talking about, and perhaps that's not really as extreme as they're claiming here. And then there's the U.S. put call ratio, which we've certainly seen things bouncing up higher, but we haven't really hit that 1.8% on a lot of occasions. There's been the occasional one here and there. So when you're looking, what
for the put call?
Yes.
I mean, I'm going to debate you on that, but all right.
Okay, what's your point on it?
My point on it is that it reached 1.2 on October 6th on the 10-day moving average, and that's the most important way to look at it when it comes
on
to
the 10-day moving average. Okay.
Yeah, when you get the again, it's the festering idea, and there's data that shows that over the last, let's say, 5 years, that's happened 3 times previously, and every single one of them was a major bottom in the market.
Which day was that it hit it?
October 6th. So it could.
So that's 2 weeks ago.
Yeah. So we may slide
been
hit
hitting
1.
That levels.
It's been hovering
the last
around.
Couple of weeks.
It's been hovering. The 10-day average has been hovering around 1.15 to 1.2. So this could be a totally different instance, but consistent with that data would be, let's say we make a lower low here and it spikes to 1.25 on that average. That's going to be a cluster of scores around 1.2 to 1.25. The point is You can go back 15 years in the 10-day moving average of the put call ratio, and you'll never find a single instance where it gets to that level and then is followed by a major persistent downtrend. Never. I mean, it could happen this time, but it has not happened.
Well, if it happened on October 6th, we've been in a downward trend, so that would be
No,
one time, no?
not. October 6th is the lower testing now on
Right.
the S&P. So we're still inside of that pattern. I mean, like,
Okay.
I'm talking about, like, do we go straight down 20% from here? You know what I mean? Like, do we move into a new
No,
bear market from here?
I hear what you're
Right.
saying.
We haven't
So
seen, so if we cluster around this area over the course of a 2 to 4 week period where it's always between 115 and 120 or so, that'd be consistent with other instances where we did that. For instance, it hit 120, when there was still another 5% to go in the March crash in 2020 in the pandemic when COVID broke out. And he got to like 1.35 eventually, but still it wasn't the beginning of a bear market move. It was towards the end of it. Like,
so
go
so
ahead.
what kind of time frame are you suggesting from that then? So you're saying it could hit these extremes. That's not calling the bottom on it.
It could get more
It could
extreme.
continue.
Yeah,
So,
but it's not that you're at the
what I guess,
beginning of a durable downward trend that's just ready to get started.
you started off the statement by saying that it's never seen, it's never had a downward trend
I said a
after the signal's been
persistence.
up.
Yeah, right. So after it
But
triggers that, you're
but
not entering a
so
persistent
what I'm
downward
trying to
trend.
get around to, Brett, with this question is what time frame was it that you were looking at? Because obviously it could still see the market slip on momentum following that number. But are
Yeah,
you saying over a 3-week
I'm
period or
talking about,
3 month
there's a
or
there's a
6 month? That's all I'm asking.
look at like a cluster of readings and a cluster of patterns and a cluster of days over the course of maybe a month or so, and that leading to like a 6-month next thing that the market is doing. That 6-month next thing has never been a downward trend.
Okay,
So I mean, like the
that's
major
what I
bear
was looking
market
for
leg.
a time frame that you were
Yeah, like
discussing
we
that.
haven't seen this be this type of score happening. I think that, like, so I did this airplane metaphor the other day in my ETF notes. Like imagine you had a little camera, a spy camera in the coach cabin of an airplane, and all you could see is a few different people sitting in the seats. You can't see anything else. You can't see how wide the plane is. You don't know anything else. You just see the behavior of like 3 or 4 people sitting in seats next to a window in the coach cabin of an airplane. Now you've got to decide: are they just taking off on an international flight, or are they just about to land? It's one of the two. And so, what sort of signals would you see? If you see them start taking off their shoes and asking for blankets, that's one reality. And the other one is they take their laptops and put them in the overhead compartment in their bags and buckle their seatbelts or maybe go to the bathroom. That's another reality. There are things that are consistent with one of those two states. So, are we starting an international flight for the next 12 hours on the downside? Or are we about to hear the captain say, we're beginning our final descent? The weather here is blah, blah, blah. Like, which one of those sorts of realities are we seeing? The reality where you get 1.2 on the 10-day average of the put call is definitely the pilot saying, we're beginning our final descent. Like that just take that, as an abstract way to process everything that I'm saying. I can't give you an exact date. I can't give you an exact time frame. Historically, over many, many, many years, that has been people putting their shoes back on, going to the bathroom, and putting their stuff in the overhead compartments. Does that make sense?
Yeah.
Okay.
Okay. So, but the bottom line here with this particular chart, Brett, probably would like to see a few more of these indicators, such as I guess we'll be getting the
Yes.
CFTC data any second here. Some of the surveys, we're talking about the AAII not really being at extremes.
Right.
The PMIs, they've been pretty weak, possibly, maybe not at extremes. So, I
It's
guess
not really the
going
same. PMIs don't reflect positioning in asset markets.
right, but I'm just saying from a survey perspective, right? I mean,
Right, but
we've
it's a survey
certainly
on
seen weaker
economic
consumer.
strength. Yeah,
Right, we
I could see
certainly
really
see.
strong PMIs being a problem because interest rates take off.
Right, but I mean, all right, Brad. I'm going. I mean, people do look at PMIs as a forward precursor for manufacturing strength, right?
Yes, they
So I
do,
mean,
but not for
so
equity pricing.
they do factor in. I'm not talking about just position. I'm
Okay.
talking in overall sentiment
Okay.
And looking at that. So from that standpoint, we really haven't seen the extremes that you'd probably want to see
Right.
to feel a little bit more comfortable about being a bottom.
Now,
Would
I
be
will
my
say there's one more indicator they don't have here that we're going to disclose in a little bit, which is hedge fund positioning, which could be on this list.
right.
It's got a
It should
significant
be on
track
the list,
record. Yeah,
probably, right?
it should be.
So I guess maybe they got a lot of their clients on that, so they don't
Yeah,
want
exactly.
to. All
Prime
right,
workers.
taking a look at positioning here. This is from JP Morgan. They are this was a question: are you more likely to increase or decrease equity exposure over the coming weeks? You can see that's been in a pretty firm downward trend really since February 2022. This is probably part of the bubble of pessimism that we've looked at, but it did creep up a little bit here over the last couple of weeks. So just keeping an eye out on that. I mean, obviously, people haven't been following through on this plan as they've
I
been
don't
sitting out
trust
on the
this
side.
indicator at all. Let me just say.
Okay.
Like, my view is people understand whether they're bullish or bearish after they transact. I think that's the fundamental rule. You tell yourself a story in your mind that you were bullish about something and then you decided to buy it. I just find I've done enough research on this to believe in my mind that the bullishness or bearishness is psychological comfort food once you've already committed to a position, which is why sentiment data works so well, because it reads through to positioning. And when you ask somebody what they're planning on doing, I think that's probably a meaningless question because they haven't done it.
Yeah, fair enough. They could do it or they could continue to hold out,
Who knows what
basically,
they'll
right?
think tomorrow?
Right. I guess my take from this would be it does appear that people are ready to pull the trigger, at least whether or not
Maybe.
get the criteria to do it
Once they
then.
buy, though, they're going to become bullish. I'm telling you.
Right. Yeah.
That's what happens.
Here's the chart in another way. Just are you more likely to increase or decrease equity exposure over the coming days, weeks? 67% said increase. So again, just kind of watching that. Here is what I was talking about with the S&P projections, where people are kind of looking at, and you can see people are pretty bearish on this. I would say
Right.
only 16% are 4,600 or over. The primary camp is really in that 4,000 of 4,400 range, which is of course where we've been uh, traipsing around really. 25% were at 4,400. Then you get that 4,200, that 4,000 area, 3,800. Mike Stanley down there at 5%, or Mike Wilson at 5%. So point being here is 45, 50, 60% of the respondents were basically looking at a level lower than we currently are right now. So Brett, how does that factor into your
Okay.
thought process here?
I say this underrepresents the bearishness because I think that the people who are answering the survey know that this is going to be a public data point, and most of them are net long. So
Okay.
I think you don't want to project to the public at large that you think the market's going to go down a lot if you're net long the market.
So you think that this should be even more bearish?
I
if
think they
people
are
were
more
honest with
bearish than they're admitting here.
us?
This
Okay.
is the softened version of the real opinion. That's my suspicion. I don't know. I'm inferring that. Granted, I think there's a reasonable basis to infer that. So I would suggest this is another data point of, relatively extreme bearishness at this point. Overall, I think that you can discount some of the bullish opinions because, again, they're not disinterested in this transaction of information. Again, I could be wrong. They could be very faithful in terms of their reporting authentic data. But I think they know this is a very public thing at this point.
Okay, just keeping an eye on things. We did get a little flush down right around to that 42.54 area. We have bounced back here. So some gyrations going on, some end of the day positioning, it looks like, more than anything in a light volume environment. So we'll watch this price action as we're chatting here. Year-end rally, Brett. 54% expect there to be a year-end rally. What do you think this survey would look like if people were interviewed about this right now?
Man, this one troubles me. Because I don't want to be intellectually irresponsible to myself. So I could say the same argument I just gave for the last one to explain this away and maintain my view is that everybody's too pessimistic. But it really is a little bit of a monkey wrench if this is authentic, and I don't know. If everybody's expecting a year-end rally, Is everybody really positioned for it and really talking the market down so they can buy more? There's all sorts of ways. This one really just annoys me. It's like that monkey. It's that data point that comes in that makes you sort of realize that, this type of analysis is probabilistic and you can never say it 100%.
Okay. Earnings expectations. So this is going into Q3. Will it be positive or negative catalyst overall for the equity markets? 80% positive. I found this pretty interesting. We always talk about the better than feared, and I assume that they're talking about it in that
Mhm.
context. And so far,
Yeah,
the
yeah,
early indications is that it has followed suit.
yeah.
On average, they're beating by 8% on the top and bottom line, I believe.
Well, look at
Um,
GDP. It's surprising everybody, right? I
yeah,
mean, the hammer hasn't dropped yet. People are
it, it,
bearish.
it's
Think the hammer's coming, but it's not in Q3 earnings.
it's really been an inconvenient truth for the Bears, just the persistent. I mean, every quarter we're expecting earnings to fall off the cliff, and they just never seem to do. Now,
And
granted, a lot of
consumption and retail sales and all sorts of things. Yeah.
yeah. Now, and I think it's really the most underappreciated story of the last 20 years, and that is how tech and now AI and everything has really just improved the efficiencies of the corporate America, and it's
Productivity.
just never really it's never really talked about properly enough. Given it, I guess it's not miserable enough to give it its just due, right? Now, a lot of the strength has been, we have seen weaker revenues, and there has definitely been an improvement in the costs, which has allowed for those margins to continue. But that's kind of part of the point, though, right? When you're looking at a company overall, you're looking at its ability to generate cash flow and things of that nature. So that continues to be working well. Earnings so far has gotten off to a decent start, but it really hasn't been able to overshadow the expectations of something's around the corner and there's rising rates. So what's your early thoughts on earnings, Brett, as we see them coming through?
Well, I mean, again, I think it's like, you could take a look at it either way. One is it's a confirmation that this is more resilient than anybody realized. But if you've got other things that are making you bearish, those are all around the corner still. Like we're creating an unsustainable situation with interest rates where they are. Eventually, nobody's going to be able to borrow to buy this and that and the other thing. And those household savings that built up through the pandemic, pretty soon they're going to be, dried up, and so really Q3 doesn't matter because the hammer's going to drop next quarter or the quarter after that. There's no way of getting around it. Like you can do that either way. So I don't know. All we know is, if there is a big bearish turn in terms of the real economy, in terms of you know in terms of like just retail spending, like consumption, all sorts of things, credit flow, everything, if that's coming, this doesn't mean it's not coming. If you're bearish, and this is a good sign that you're on the right track if you're bullish. But everybody agrees that it didn't happen in Q3, and we can see that from that Atlanta Fed GDP now.
Yeah. All right. Here is the hedge fund exposure chart, Brett.
Yeah,
Obviously, we could
pretty
see,
convincing to
yeah,
me.
that
To me,
that big dive down there puts it in that once box cycle.
puts it in the box.
What's the box? Yeah, what's in the box there, Brett? What does
Yeah.
that box represent there?
Just sort of, when they're extremely short. I mean, I just generalized along an area that seems basically like, so, we had that chart earlier where, who was it from Goldman, where they did the, 12%, only 12% of the time is an extreme reading. So they just base it on 12%. That sentiment indicator chart where we said this should have been one of the factors. So that box is my version of 12% in this chart. Just I took, across all the times when it's sort of, extremely below where its center of gravity normally is, and then I drew a green vertical line to pair those spikes, those extremes up with what the market does next. You can see the S&P on the top, and right, we're in that green box now. We're at the bottom of that green box. There's never been a move very far beneath the bottom of that green box. So when you're looking, and it
2019.
goes back 8 years. I mean, yes, it could be, if we went back further, perhaps we'd find something that was, but really, you've gone through a lot of stuff in the last 8 years. And really, they haven't been much more short than this. And every one of those instances, except for one, and there is that one outlier. So there's 8 8 times it happened, one of those 8 times precipitated a decline. So you can see it's the red circle on the chart. The rest of them, they all precipitated some kind of
What would that
ensuing
have been? The
rally.
trade wars?
I don't know, in 2018, February-ish, I think. I think it might have been, you know,
I mean, I know that's when the trade wars
or no,
picked up, and
later in 2018. Maybe it was, but either way, here's the data set. Here's the number of instances. And there's lots of points where you can see the major bottoms correlate with this. And what I also did was I overlapped that put call 10-day moving average with this. And there's like 4 times where they meet up, and every one of them has been a significant low. So we've got them both happening right now. Obviously, we could be on the verge of World War III, and when people look back at this 50 years from now, it's just insane to buy right in front of the beginning of World War III. And of course, it's different from the last 8 years of data, and that's possible. And in fact, it's not that crazy to think about right now. Just as an example, like this is a really strange period, certainly geopolitically. You get an alliance between Hamas and Iran and Russia. God forbid China too, fully all in, and then you've got Europe and the United States. And so there's lots of scenarios you can engineer in your mind to account for how this could be outside of a data set covering the last 8 years. But, if you just look at how this positioning indicator has tended to, it's the airplane again. Like, are people, just asking for a blanket and turning the lights down, or are they, putting their shoes back on and putting their laptops back in their overhead compartments? Are we at the beginning of a persistent bearish trend that's just getting its legs now? And next week we're going to be down 8%. The week after we're going to be down 6% more. Pretty soon we're going to be back at last October's lows and just a straight kind of grinding downward move like we see in really big bear markets. Is that what we're taking off on right now? Well, this indicator really, there's been one time in the last 8 times when something like that has been the case. But certainly that one time was filtered out if you're also looking at that put call data point.
Okay. Moving along, hard landing versus soft landing. Do you think this debate even matters really, Brett, at this juncture?
Not at all.
Fair enough. We'll skip through there. Here's one item that I found interesting from this week, probably underappreciated. China's sentiment obviously remains very bearish, but we did see a little bit of an uptick. And I would note that the data from China was a bit of an uptick. So I kind of look at this. I want to call it a black swan, but doesn't seem like anybody thinks China's ever going to be able to recover. And we've seen the Chinese government taking some additional steps to improve the market sentiment. Obviously, looks like we could be getting towards the end of that property bubble issues when we finally start getting Country Garden and some of these companies pulling the band-aid there. So do you see the potential for China? I don't want to say saving the day, but for perhaps improving sentiment that's out there if we start seeing them kind of help with some of the heavy lifting?
I think that it's been Beijing's priorities that are a problem, and they shifted maybe a year and a half ago from prioritizing like this growth agenda, this creating this rising middle class, to being much more focused on kind of fencing in certain cultural themes in terms of its longer range goals. And I think that signaled a big issue there. And so the question is, they've got the ability, I believe, to, if they were to have the growth be the main point on the agenda, to have a significant impact on all sorts of things in terms of the global outlook. But I think that it's a political, cultural, and agenda-based problem, as well as obviously a basic economic problem, but they've got the ability to try and fight that much harder than they have if they were to choose to. And I think that people are losing faith that they're going to choose to.
All right, just keeping an eye out. Markets slipping to the session lows, testing that 200-day moving average there. Trying to bounce up. So little bit of horse trading going on at the end of the day here. All right, tail risk spread. I know you hate this chart, but
Yeah,
just taking a look at it, high
I love
inflation
this
keeps
chart.
central banks hawkish. That still remains the top one. Geopolitics worse, and that's number two. Kind of surprised, maybe if we go to next month's survey, if the Israel issue still remains unresolved, we see that spike up. Global recession hard landing at 21%. Systemic credit event, AI tech bubble. I'm kind of surprised that one's. I guess it's dropped off a bunch, but and then China real estate. Nothing really jumping out to you on this chart, right?
I guess I'm a little surprised at this point that 2 hasn't moved past 1.
Yeah,
A little bit. Yeah, I mean,
I
maybe
it could it
maybe
could
when
just be
this question
timing
was
of the
asked.
survey. Yeah, exactly.
Yeah, we hadn't had
Because
the
they,
full.
they do run it over a 10-day period, and I'm pretty
Yeah.
sure that it would have started like around October 4th or 5th in that area.
Yeah. So I think we're
So
missing that. So we could probably assume that's the number 1
yeah,
run.
I'd like to see the linearity of this. Like I'd like to see this response in the first 5 days and then post Israel, like what that did. Credit risks, which is kind of funny because it's got China real estate bust up there. It doesn't have anything about the U.S. commercial real estate, but we see that as the top credit risk out there. So commercial real estate, we're just talking about the regional banks and the weakness going on there. Certainly, this is one significant headwind for them. 1 in 3 people say the U.S. EU commercial real estate was the most likely source for a systemic credit event. China real estate, that's next. Again, we're starting to kind of get the band-aid pulled on those. Then U.S. shadow banking, U.S. government debt pops up onto this here, and then Japanese government debt pops on too. So anything jumping out to you on this front here, Brett?
Yeah, I mean, I don't know. I don't want to commit to that statement.
Fair enough.
Next time, give me a couple weeks and I'll look back at this list and I'll commit to it.
Okay. So this brings us to our conclusion, Brett. Now, I'm still of the camp that I think we'll have a strong finish to the year. Obviously, we're going to be. It's going to the potential highs are going to be much lower at this juncture, given the fact that we have dropped about 150 points. But we really haven't gotten crushed, given all the data points that we're facing now. My biggest concern, and we've been talking about throughout, is that we're not really getting to those bearish extreme levels that I think you would want to see. Now, we have seen this play out before around earnings season, and we have seen the mega cap banks kind of ride to the rescue to a certain degree and really help turn the temperature in the room, which I think
Mm.
is why the next 2 weeks are going to be critical for the year end. I mean, it's very possible we could get a flush out, but I do think if the Bulls are unable to mount any sort of a comeback at all over the next 2 weeks, you start getting deeper into that tax loss selling and things like that, that it's just going to really build on itself for the momentum. So while I still remain in the bearish camp, I'm not blind to the risks out there. I'm not whistling past the
Oh, bullish
graveyards.
camp or bearish camp?
The bullish camp. What did I
You
just
said
say?
bearish.
I'm sorry, bullish. Still in the bullish camp, to be clear. But I definitely am questioning that, given some of the issues. Now, I always find that it's easier to be bearish because it's the wall of worry that we're always climbing out there. That in your verb and your ag and your talking to be bearish, but then I find most people tend to be. It's easier to be bullish in your actions. So I'm still of the mindset that we will see things settle down, and that the econ data is strong enough that we'll be able to mount a push higher, that the earnings are going to be good enough to continue to push us higher going into the end of the year, and positioning still remains in favor of the bulls. But I do have some question marks about it, given some of the recent data and the fact that we haven't just hit that bearish extreme yet. So that's kind of where I stand. But Brett, I want to know where you stand as you digest all the data that we've talked about over this last 60 minutes or so.
Yeah, so I said that there's this sort of like this kind of tension between these two analytic elements that I trust a lot. One of them is the tone and mode of market behavior, and the other one is sentiment and positioning data. And to resolve and reconcile that tension, obviously the tone and the mode of market behavior is terrible right now. Like, I mean, the weekly bar in Europe is just awful. There's a lot of we're just really close to seeing small caps to a multi-year low. Transports are just getting destroyed. There's a lot of sector charts that look awful. So I could just go through things that are like, I don't associate this with a good time to be, loading up on stocks in my experience, just from the chart patterns. At the same time, there's that airplane metaphor. And like, so really the question is this the beginning of a persistent bearish trend, a new leg of a bear market that started in January of last year, where we got a lower high that formed in July of this year? And then we start that move down to 3,000 or whatever. And it's, you look 20 years later and you just see this big kind of seesawing bear market period that lasts 3 or 4 years. Like there's a view, right? And some people have that view. And I could find all sorts of reasons to argue for that view in terms of what I think is going to happen next year in terms of the political situation, the geopolitical situation. You can make valuation arguments in that direction. Let's say we see an uptick in inflation again. There's all sorts of easy explanations to paint that picture. And a lot of people are painting that picture. And a lot of people painting that picture results in the data that we talked about with the put call ratio and the hedge fund short exposure. And if you look at, the last 8 to 10 years of data, we're at a point with multiple different important indicators where there's been a near 100% success rate in predicting a very near-term important market low. So I'm one at the end of the day to probably trust more the positioning data, because I that equation makes sense to me. The market is a discounting mechanism. There's something in it that explains the higher prices for where these extremes are happening than where they happened the last time. But that foundation is still in place where we've got people who are super hedged and super short right now. And that's usually not the way a major downtrend starts. And there's a ton of data to support that basic premise. So I kind of resolve in that direction. And so the upshot of all of that is, I'm probably going to be expecting more downside next week. And possibly a capitulatory move in the bond market that's really ugly. And anybody who's buying a lot right now of bonds and stocks is going to be really unhappy, maybe at some point next week. But as we move toward early November, we're going to see a different tone to the market. That's my expectation.
Yeah, I would agree wholeheartedly with that. So setting up for an interesting week, that's for sure. All right, Brett, we just got 10 minutes left here in the trading day. We're going to be shutting down audio here as we tune out. I'm not going to restart it unless I see anything worthwhile. Obviously, looks like we're trending towards the session lows going into it. But Brett, as per usual, thanks for jumping on here and chatting with us about this. I will be posting the replay of the Sentiment and Flow Show to audio here shortly. So if anybody's got any questions, let me know, and we'll be happy to get you help you out and get you any answers to your questions. So Brett, you have a great weekend there, and we will talk to you next week.
You too, Gav. Sounds good.
All right.
Take care.
Take care.